What if the biggest market shifts of the last 150 years, the crashes that wiped out fortunes and the booms that created them, were all laid out on a forgotten chart from the 1870s? And what if that chart wasn't made by a Wall Street analyst, but by an Ohio farmer who lost everything and spent the rest of his life trying to find order in the chaos? That farmer was Samuel Benner, and in 1875 he published this, a hand drawn map of the market's future. It has since pointed to major market peaks and crashes with what can only be described as eerie foresight. The warnings for the Great Depression, the dot-com bubble, and the 2008 financial crisis were all there, sketched out decades in advance. Now, that same chart is pointing to a major financial shift starting in 2026. This isn't just a history lesson, it's a potential roadmap for the next decade. In this video, we're going to unpack it, look at the evidence, and reveal what this farmer's forecast says is coming for your money. To get the prediction, you first have to get the man. Samuel Benner was a prosperous Ohio farmer. Life was good. But then the panic of 1873 hit, a devastating financial crisis that tore across the nation. Benner, like so many others, was completely wiped out. He lost his farm, his fortune, and his sense of security. But where others saw ruin, Benner saw a puzzle. As a farmer, his entire world was governed by cycles. He knew nature had a rhythm, a time to plant, a time to grow, and a time to harvest. So he looked at the wild swings of the financial markets and asked a simple question: does the economy have seasons too? He dove into historical data, searching for patterns in everything from corn and hog prices to the price of pig iron, a key industrial metal of his day. And what he found was remarkable. He identified several repeating cycles. He saw an 11-year pattern in corn and pig prices, with peaks happening every 5 or 6 years. He also noticed a longer 27-year cycle in pig iron prices. Benner had a theory that these market rhythms weren't random at all. He believed they were tied to something much bigger, the 11-year solar cycle of the sun. His thinking was that solar activity affected crop yields, which then sent ripples through the whole economy, influencing supply, demand, and prices. It was a grand theory connecting the sun, the seasons, and the stock exchange. In 1875, he put all this research into a book, Benner's Prophecies of Future Ups and Downs in Prices. Inside, he published his master chart, a forecast that stretched for decades, all the way to 2059. At the bottom, he wrote a confident two-word declaration: sure thing. For the next century and a half, the world would find out just how close he was. So, it's a great story. But how did this 19th century farmer's forecast actually do? This is where it gets interesting. Benner's chart wasn't just some vague prediction of booms and busts. It split time into three distinct categories, each with a clear instruction. Category A he called panic years, the times he identified for market crashes and extreme volatility. Category B was for good times. These were years of high prices and stability. For Benner, this was the time to sell stocks, property, and whatever else you owned. And category C was hard times. These were the years of low prices and bear markets. But this wasn't a time for fear. He saw it as the single greatest opportunity. This was the time to buy. The strategy was simple: buy when everyone else is panicking during hard times, and sell when everyone is celebrating during good times. So let's look at the track record. One of the most powerful examples is the 2008 global financial crisis. The housing market was on fire, and it felt like the party would never end. But the farmer's chart designated 2007 as good times, a period of high prices and the perfect time to sell. Anyone who followed that advice would have moved their assets to safety just before one of the worst financial crises in modern history. Then there was the dot-com bubble. At the turn of the millennium, tech stocks were flying. People claimed the old rules were dead. But Benner's chart flagged the year 1999 as a panic year, a time of dangerous highs. Right on schedule, the bubble peaked, and in early 2000, the market began a collapse that erased trillions in wealth. However, it's really important to understand this is not a crystal ball. The Benner cycle's biggest weakness is its lack of precision. Its predictions can be off by a year or two. For example, it warned of a panic in 1927, which was 2 years early for the actual 1929 stock market crash. While that warning was early, it would have put any follower on high alert right before the Great Depression. Its accuracy isn't perfect across the board. Research shows it has had mixed results in calling the exact tops of markets and has been less successful at pinpointing the precise bottom of bear markets. This tells us something critical. The Benner cycle isn't a market timing tool for day trading. Its real power is as a long-term, macro-level weather forecast. It tells you what financial season you're in, whether it's time for planting or time to prepare for a coming winter. So we have this 150-year-old chart with a track record that's tough to ignore. But the biggest question is, what does it say is happening now, and what does it predict is just around the corner? We're about to get into the specific dates. If you're finding this valuable and want to see how this all unfolds, take a second to subscribe and hit the notification bell so you don't miss our updates. All right, let's turn to today. It's late 2025. Where does the Benner cycle say we are, and where are we going? According to Benner's framework, the period from 2024 through 2026 is designated as favorable years for investment. This is the good times phase, a window known for high prices and market strength. In Benner's own words, this is the time to sell stocks and values of all kinds. The cycle is forecasting that the current bull run will reach its peak sometime in 2026. This is the critical turning point. The chart flags 2026 as the end of the party. After this peak, the cycle predicts a major shift. The period from 2027 all the way through 2032 is marked as unfavorable. This is Benner's hard times, a multi-year stretch of lower prices, economic weakness, and potential recession. So, to be crystal clear, the prediction is this. The window to take profits and reduce risk is between now and the end of 2026. The cycle then points to a significant period of struggle beginning in 2027 and lasting for roughly 5 to 6 years. What makes this so fascinating is how it lines up with Benner's original inspiration, the sun. NASA and NOAA have forecast that solar cycle 25 will reach its peak, the solar maximum, around 2025. After that peak, solar activity is forecast to decline until the next solar minimum around 2030 to 2032. The alignment is remarkable. The peak of solar activity matches Benner's predicted market peak, and the sun's decline matches his predicted hard times. A coincidence? Benner would have said absolutely not. Now, it's vital to correctly interpret what hard times actually means. It doesn't guarantee the market will be down every single year from 2027 to 2032. Historical analysis shows that even during Benner's unfavorable years, the market can still have positive returns. What it really signals is a period of much higher risk, higher volatility, and lower average returns. It's a time when making money gets a lot harder and preserving your capital becomes key. It's a stock picker's market, not one where a rising tide lifts all boats. The easy money, according to this chart, is about to end. A forecast for a multi-year downturn might sound scary, but to see it that way is to completely miss the point of Samuel Benner's work. He didn't make this chart to scare people, he made it to empower them. In his mind, the hard times weren't the end of the story. They were the start of the greatest opportunity. His entire strategy was built on one powerful idea. You get rich by buying when everyone else is terrified. The 2027 to 2032 period is exactly what he identified as the good time to buy stocks, and hold till the boom reaches the years of good times. So, how do we translate this into a practical strategy today? First, and this is the most important rule, don't use the Benner cycle by itself. Think of it as a compass, not a GPS. It gives you the general direction, but you need other tools like modern financial analysis to navigate the terrain. Second, use the cycle as a long-term guide for managing risk. Based on the cycle, the period from now through 2026 is a time to be increasingly cautious. It suggests investors should think about gradually reducing risk, taking profits on winners, and getting ready for a change in the weather. This doesn't mean sell everything tomorrow. It means preparing methodically. Third, get ready to become a buyer. The heart of the strategy is building up cash or dry powder during the good times so you can deploy it when the hard times hit. When markets are down and the headlines are all doom and gloom, that is your signal. The investor who is ready with cash can buy great assets at prices they might not see again for a decade. It's the wisdom behind Warren Buffett's famous advice. Be fearful when others are greedy and greedy when others are fearful. Benner's chart is basically a calendar for when to do each. And fourth, adopt a contrarian mindset. This is the hardest part. It means having the discipline to buy when your gut is screaming sell. It means having conviction when the whole world seems to be panicking. Benner knew this because he had lived through it. His chart is a tool to give you the confidence to act against the herd, based on the idea that these cycles have repeated for centuries. The prediction for a shift in 2026 and a downturn from 2027 is not a prophecy of doom. It is a roadmap to opportunity. So, there you have it, the story of an Ohio farmer who, after losing everything, looked for a hidden order in the chaos of the markets. He believed he found it in the rhythms of nature and the predictable cycles of human emotion. For 150 years, his chart has served as a strangely insightful guide. Now, that same chart tells us the good times are set to peak in 2026, giving way to hard times until 2032. But as we've learned, these hard times are not a threat, but a once-in-a-decade opportunity for the investor investor who is prepared. Is the Benner cycle a perfect crystal ball? Of course not. Today's markets are far more complex than in 1875. But as the saying goes, history doesn't repeat, but it often rhymes. The cycles of fear and greed, of panic and euphoria, are as old as we are. Samuel Benner's great idea was to give us a calendar for those rhymes. Those who listen to the echoes of the past can position themselves for the opportunities of the future. The chart says a major shift is coming. The only question is, will you be ready? Thanks for watching. If you found this insightful, please subscribe for our ongoing coverage. And let me know your thoughts in the comments. Do you believe in these long-term cycles?